All right, so in today's class, we have a few things we need to do. Apologize for being sick, but regardless, I had to finally get somebody to look at this. But in any event, first thing I want to do is talk about the stock sim. So this is the current section, section 201. This is the ranking as of today. What's going to matter is the trading sim will end on Wednesday, December 4th. At the end of that class, we'll check the rankings. Very important that you make 10 more longs than you did in the first half of the semester. So take the screenshot that I posted with your first half rankings, look at number of longs, and by 2 weeks from Wednesday, make sure that that number is 10 higher. Okay, so that's what you need to qualify for the second half of the semester. And make sure that you continue to stay out of cash. So for example, in this section right now, the company in third, J Tobbs team, which has $415,000 of available cash, is getting a warning. This is what gets you disqualified. So buy something very quickly. You're not allowed to be in this much cash. But the other thing I will mention about the competition is it's interesting how even a month from the first submission, everybody was losing money. Now everybody's making money. Right? And so there is a strong correlation between the market performance and how you're doing. Right? Matter of fact, when I present at the SIFMA conference every year, I showed data last year that basically over a 25-year period, it was only 10 or 20%, I think it was 10% of asset managers outperformed the Vanguard S&P 500 index over 25 years when fees are included. It's really hard to pick individual stocks. And part of it is what asset managers tend to do is they diversify. So they start buying lots of different stocks. And when you start building a portfolio with a lot of different stocks, you know what you start to look like? Exactly, the market index. And so what you end up doing is you end up replicating the market index for fees, and that's why it's actually kind of hard to buy so many stocks. I'm not saying you can't find stocks that outperform, but that's the one challenge that you have as an asset manager. That's why I have another friend at Harvard who wrote a paper on this a number of years ago, but he basically said if you have a choice between a big fund and a small fund that have the same portfolio, you want to own the small fund. Because at some point when you get to be too big, you have to invest essentially in the market because you run out of investments to deploy all that capital. And there's actually a diminishing returns to the bigger funds. It's not that they're not smart. It's just, it goes back to how much can you buy, and you start buying more and more stocks, you start looking a lot more like more the market. So in any event, just that's kind of how we're doing. Wanted to show, we're going to quick check it on the score. The other thing I want to mention is your final presentations will be on December 2nd and 4th. So what's going to be also important is on that date, everybody will turn in your assignments, both the PowerPoint, the paper, the Excel files, basically by Monday morning at 10 a.m. Right? And then everyone will present on either Monday or Wednesday. So again, this is section 201, I believe. Write this in here. Just want to make sure we're going to give the order of the presentations. So who goes on Monday and who goes on Wednesday. I'll define that today. Does anybody have a preference or necessity to go on one of those 2 days? Take volunteers first. So half of you will present on Monday. The other half of you present on Wednesday. Yes?
I think one of our members will be super down Monday, so we're probably going to do that.
Which team are you, or which company are you doing?
We are doing
MGM? Okay. So MGM is Wednesday. Anybody else have a preference for Monday or Wednesday? Yeah.
Go first.
Sure. Which team?
Hyatt.
Hyatt. Okay. So Hyatt is not only going to go Monday, they're going to lead off. Who else? Yeah.
We'll go Monday too.
Which team?
Marriott.
Marriott. Hyatt and Marriott. Got a few more to schedule. Who else? Any other preferences before I start putting you in?
I'll go first. None of my team's here, so I'll make the decision.
Which team?
Go for Carnival.
All right. So Monday will be Hyatt, Marriott, and Carnival. Wednesday will be MGM. Who else is left? What are the teams we not talked about? MGM, Hilton, and who's the last one? I'll look you guys up then. Who's the last team? 6 teams in here. MGM, Hilton.
We're the last team. I'm not sure what company we have though, actually.
You're not sure what company you have?
Yeah.
Because you forgot or what?
Uh,
Because at this point, you should hopefully know. Let's see what I have in here. How about that? We save this. People. Project teams. 2 p.m. Carnival, Hilton, Hyatt, Marriott, MGM, and what is this? Team 2? Oh, it's because you never chose one. You're the team who never chose one. So before we leave class today, Mystery Company X, we're going to have to figure out who Mystery Company X is. What you guys are going to do. All right, but you're going on Monday. What's what?
sorry, I must have missed the day that you said the industry that we had to pick from.
Hotels.
Hotels, okay.
Talk to me when the class ends and we'll figure it out. So actually, sorry, you get Wednesday. So let's call you Company X. All right, so related to this, very important ground rules, which I'm going to keep repeating so that there's no ambiguity about grading and requirements for these presentations, right? So number 1, all teams have to turn in all files by 10 a.m. Monday morning. You have to present using that file that you turn in. You can't use outside that file that you turn in. All members of your team must be part of that presentation. Okay? So if you have 6 people, all 6 people have to talk. Now you might only talk for like 30 seconds, so it doesn't have to be an equal amount of time, but everybody has to talk. If you don't talk, you don't get credit for the grade. Okay, so you have to be here and physically present, and that's going to be very important to your grade. It's 20% of your semester grade, 12 points of the PowerPoint, 8 points of the paper. Okay, so back to the 20 minutes. Because it's 20 minutes, essentially for the PowerPoint, think of 4 sections: EIC, historical, multiples, and evaluation. Should be about 5 minutes per section. Okay, the points are divided equally across the sections. So on the presentation, 3 points per section. Times 4 sections is 12 points. On the paper, 2 points per section. Times 4 sections is 8 points. Okay, so again, make sure you submit that, right, and stick to your timeline. When you're doing the presentations, if you run out of time and you don't cover the section, even if it's your PowerPoint, you don't get credit for the section. So just be careful, because for example, I've seen in the past, EIC, people can take 12 minutes in EIC. Okay, and I'm not saying that it's not a thorough, great job, but then you got 8 minutes to do the other 3 sections and you're running out of time. So just make sure that you're efficient at covering what needs to be covered in each one of the sections, and make sure you cover that. I will put up a more specific rubric and all the data required. Make sure you also submit all of that and talk about that in each of the sections for your grade. The other thing, and I've been saying this since the beginning of class, that how you come to class and whether you come to class any other days, I don't care, right? Many of you come dressed as if you're, just got out of bed or you're going to the gym or whatever you're doing. That's fine. But for those 2 days, the rules of the class are different, right? Rule number 1 is you're coming minimum business casual, okay? No sweats, no shorts. I mean, it's cold, it's probably you won't wear shorts. No flip-flops, no sandals. Shirts with collars for men, equivalent for women. I'll let you guys figure that out. But basically, you must be business casual. I'll accept jeans, but I won't accept anything else. I am not appropriately dressed for that class, right? I was sick this morning. I dragged myself out of bed. I came in. But the point is, even those 2 days, I've been very casual. Generally, I don't care how you come to class. Those 2 days, I do. You will, both days, whether you're presenting or not, you will come dressed business casual or better. I don't expect like a business suit, but I do expect at least a decent shirt and or not rip-torn jeans. So if you want to wear professional jeans, that's fine. It's not one with rips in it and no sandals, right? No flip-flops, anything like that. So he's not, I'd kick him out of the room. I wouldn't let him in the door. And he'd lose a big chunk of credit for his grade because he's wearing sweats. Today, I don't care. Right, he's fine. But for those 2 days, we will all come professionally dressed. Number two, for those 2 days, I see many of you. You're on your phones, you're on your computers, you sometimes pay attention, you sometimes text other people. It's your money. I don't care. It's up to you. If you don't want to learn, can't force you to learn, except for those 2 days. For those 2 days, computers will be down, phones will be off, you will sit in your seats, and you will pay attention to the people that are leaving. Otherwise, I will rudely throw you out of the room and give you a 0 for the group project for the entire semester, and basically humiliate you in front of everybody else. And I'm doing this, not for me, I'm doing it for the people that are presenting. And if you don't think I'm serious, talk to people in last semesters. I've dragged people out of the room before, right? And then they come back to me crying about how bad it is for their grade, and I say, look, I'm serious. And what I mean by that is a lot of people are going to have stage fright. They're not used to these presentations. They're under a lot of pressure. It's a big percent of their grade. They take it very seriously. So we're going to show them respect. And we're going to politely listen to them for both classes, 90 minutes twice for the semester, and we're going to be professional about it. And we're going to make sure that they have that respect to present for their grade. And we're all going to listen politely. And if you can't do that, then talk to me, because you can't be in this classroom doing it. So, and no warnings, this is your one and only warning. If I hear a cell phone go off, if I hear a beep, I will stop that presentation, I will ask you to leave, and you'll get a 0 for the group project for your semester grade. Okay? And there will be no warnings. This is your first and only warning. Second, if you don't show up that day, and there's one person out of 160 right now that has an excuse, which was verified in writing by somebody else, and if you don't have that, you're losing 5 points if you don't show up for the day that you're not presenting, and you're losing 20 points if you don't show up for the day that you are presenting. So whether you're presenting or not, you're here both days. It's been a requirement since the beginning of the semester. It's a requirement at the end. And I woke with a tummy ache does not qualify as an exception. If you're sick on that day, written doctor's excuse is the only acceptable exception at this point to missing that day. And I'm just being harsh because that's what I require for this class. Very little requirements otherwise, but that is the attendance requirement, and we'll take attendance both days. So very clear about that. Your question?
I was just going to ask if we had to address business casual for both days.
Both days. Whether you're presenting or not, both days. You're covering business casual both days. Or better. You're welcome to dress up more if you want. I'm not going to grade you on overdressing, but I will penalize you for underdressing. Okay? And if you have a question about what business casual means, feel free to talk to me. As I said, I'm not going to go for a hard rule, but as I said, don't come like you're looking to go to the gym after this class. Okay? Think about it as if you're going to an interview. All right. So back to the requirements. That's the project requirements for those presentations for those 2 days. So working backwards. Some of you are probably like, all right, I haven't done this presentation before. It's perfectly acceptable to use notes. So if you want to use note cards or write out some things that you want to talk about and even read from a script, that's fine. I'm not going to penalize you for doing that. I'd much rather you explain the information to me factually that's correct than get nervous and forget about that. So if you need to write notes, that's great. However, I can't grade what's on your notes. I can only grade what you say and then what's turned in the PowerPoint. And number two, all of you still have to present. Okay? So again, make sure that you break out the presentation accordingly. And I will ask at least one question to all the teams. And I won't know what the question is until I hear you present. But I'll tell you the basis of that question, which will affect your grade, will come from one of two things. I'll either see something in your presentation that looks a little bit interesting or off, and I'll definitely ask about that. Or if your company's in the news. So for example, if your company was Under Armour and you're in the news right now, I'd ask you a question about how earnings management has affected their results. Right? And if you're like, what do you mean by that? Then that means that you're not keeping up with your company. So I read the Wall Street Journal every day. I read Bloomberg.com every day. I'm not saying I'm going to go looking for information about your company. If your company's in the headlines, you need to be prepared to discuss that impact on your company, regardless of the date, even if it happens the morning of your presentation. Not saying you have to adjust your numbers, but just be aware about your company. Because if I'm aware about it, you should be aware about it. Right? So that will be the source of the question. Anybody on your team can answer it, but that will also be part of the conversation we'll have. Generally, I'll try and ask my question at the end and let you try and get through your presentation. There'll be a timer on my iPad, 20 minutes. I'll set it up as a countdown timer at the front of the room. When it hits 0, then you're done. Okay, just to be equal time for all 4 teams, or sorry, all 6 teams. So everybody will have the equal time of 20 minutes. All right, so that's next Monday and Wednesday. This Thursday, TAs are having office hours. And what I would suggest is if you want to do a dry run, or if you want to get specific feedback about your presentations, see the TAs. Because they did this last year, right? They were in your shoes creating these PowerPoints and making these presentations. And all of them were on teams that did a good job. So if you want to kind of get a sense of things that will help you in your grade, take advantage of your TAs. I would just strongly recommend that. I'll help you with the presentation, except I don't want you to do the dry one with me because I am the only person that's going to grade those presentations. And so if you do a bad dry run with me, it may or may not influence my grade. So I don't want you to do a dry run with me. I'll answer questions, but I want you to do, if you want to do a dry run, schedule it with the TAs and talk to the TAs. The other thing is next Monday, 1 week from today, as part of the class, I'll give you time to ask me questions in general about the projects. So it'll be a shortened class on Monday in terms of content, because I'm going to leave part of the class to just help you guys with data problems, a la what's going to come up in the Caterpillar assignment that we're going to talk about in a few minutes. But regardless, that will be. So just to do our final scheduling here, today, Monday, Wednesday, we'll have our final assignment. It'll be an in-class assignment, but it will be due on Monday in case you don't finish it in class. We'll talk through it on multiples, one more practice run for that. The following Monday, the last class before Thanksgiving, we'll debrief the multiples assignment and then make the class basically available to help you with group projects, right? And then Thursday's Thanksgiving, come back, group projects for the 2nd and the 4th. So getting here near the end of the semester. Right? So let's talk about Caterpillar. I'm guessing that when you did the as-is valuation of Caterpillar, many of you had a problem. All of you should have had this problem, where you couldn't match the share price and the model multiples. Is that a fair statement?
Yeah.
Okay. And so you had to choose between one or the other. All right. So let's start the problem. Which one should we have chosen? To match the share price or match the model multiple? Yeah.
I chose to match the share price because
I agree with that. Let's start with the share price first, but go with your rationale.
so I thought that because it's a cyclical business, that the next 2 years of multiples that we estimated would not be representative of the long-term growth.
That is a very good rationale, but unfortunately it's not enough. But it's moving in the right direction.
To add on that, a lot of the important part of this model comes in that 6th year for continuing value. And if that 6th year is at a specific point in the business cycle, then you're going to have a really rough time actually representing the full history.
All valid. But unfortunately, and I didn't realize this when I chose CAT, we ran into another problem. So welcome to the real world. What's the other problem beyond what they just described that causes the difference between the Bloomberg enterprise value and our model value? Yes.
Is it the fact that it's averaged over a year?
Not necessarily. So here's where we have to play detective work. Yes.
Aren't there like additional adjustments that you needed to make?
There we go. It's the additional adjustments. So a few students emailed me, and I tried to give them a cryptic answer because I want to give an unfair advantage. Because sometimes I know it's easy to plug and chug, and in this class you can plug and chug a lot. This is something you can't plug and chug. Like sometimes you got to figure stuff out, and you got to think it through. And so at this point, why is it different? So where I gave him a hint, I said, look at the valuation tab, and then look at Bloomberg. Compare. That's where it's going to give you some insight. I think that's what he was starting to point out. So let's look at our valuation tab, and let's look at our enterprise value that matches the share price, right? And we're at 102 billion, okay? And here's the point. When we go to Bloomberg, if you go to CAT, every time you trade, I get an email. So hold on, I get rid of the emails because they drive me crazy. Go right over that search bar. CAT, U.S. equity, and then you can go directly to the FA screen. And it's actually FA EV, gets you directly to the enterprise value tab. So it's FA and then the enterprise value tab. But it's also on the highlight tab, which is the one we looked at. But go to the enterprise value tab. And you're going to first notice two things. Number one, this enterprise value for 2018, close to today, is far different than the one we have in our model. Okay? And even with the adjusted enterprise value, without making the adjustments in our model, you'd have had 94. Okay? So that's the problem. We're at 94, call it 95, and we need to be at 74, 70-ish. Obviously changed a little bit from that date. But that's the point. We're off. Okay? And that's the problem. So we got a share price 1 and we got an enterprise 2. Second thing you notice is why are we off? And we're now at Sesame Street. One of these things doesn't look like the other. We talked about the Bloomberg definition of enterprise value. Do you notice anything different here? Adjustments. $27.6 billion. Exactly. There's a $27.6 billion adjustment that Bloomberg is making to CAT's enterprise value. And that's non-standard. And this is what I was kind of railing about earlier this semester. So when you think of a raving lunatic, this is why. This is the stuff that bugs me. Because this is the standard definition of enterprise value. And here's an example. We ran into a company where they made an adjustment to the standard definition that's one time just for Caterpillar. And if you don't pay attention to this, then you could easily miss that they made an adjustment here. Okay? But the more important question is, why'd they make the adjustment? And what's this $27 billion that's suddenly here that wasn't in our model that we're missing from the financial statements? So this is, again, another advantage of Bloomberg. If you actually click on a number, it'll actually tell you where they got it from. And what it basically will show you is most of the adjustments come from a finance subsidiary debt and adjustment. Okay, so I didn't do too much digging, but here's the whole point. Caterpillar makes money two ways. One, they sell you the big Tonka toy excavation, loader, whatever equipment to basically get the stuff dug. They make those. Two, they finance those. And so the financing is in a subsidiary that appears when you dig through on a number here. Here's the long-term debt associated with a machinery, engineering, and transport. And here's the one for financial products. When you actually click on it, it'll bring you to the original document, another nice feature of Bloomberg. So when you start reading through this, what you see is that buried in the footnotes is some data from their financing subsidiary. Now, Bloomberg had gone through the footnotes, which is one of the things they do, and they made the adjustment to go find the hidden debt. But Caterpillar basically has some hidden debt. Okay? And so this is the problem that we run into in the real world. So when I was telling you a few classes ago, I said, look, these accountants are pretty smart. They know how to hide things. And so in Caterpillar's case, if you're not paying attention, it's $27 billion of off-balance sheet liabilities are sitting here that nobody paid attention to, that in a cursory view you would have missed. And that's what's affecting the multiples, right? So that's the adjustment. And so in our model, how should we handle this? Yes?
Put in what the Bloomberg enterprise value is for that?
Well, why don't I just hard code that number, but at least make the adjustment here to get the model to be closer. Because the problem is, if we look at what we were adjusting, we were adding debt and equity. And I could go back and I could look. That 41 of minority interest, go back a screen here. Hate this keyboard. I told the last class, I am selling this. If anybody wants to buy a 2-year-old, slightly used MacBook Pro, I'm selling it because I can't take it anymore. I'm buying the new one. I think Apple did that intentionally. All right, so back to this. When I go back here to the Caterpillar data, just look at it holistically, like 41's 41. The debt of 36 36. Okay. So essentially, retirement-related liabilities dropped. Don't see that in the Bloomberg calculation of enterprise value. So there's $7 billion change. And I don't see the adjustment. And then cash is going to be close to the cash that we have. So if I really look and see where Bloomberg was changing things, for Caterpillar, we're missing those two things in their definition, which is here. And by the way, the pension was actually in the enterprise value they had for whatever company we were looking at last week. Was it PVH? I don't know. Who did we look at last week? Costco. Was it? Because Costco didn't have a pension, it was zero. But basically, here's a company with a pension that they put elsewhere, and it didn't include in the enterprise value. They included the adjustments. Okay, so sitting there in the adjustment is the pension and the off-balance sheet financing liability. So let's go back. What do we got to do? I would say simplistically, take this, subtract the 27,649, and then subtract the where's the pension? 74.55. And now our multiples. So go back. Take. What did I do earlier? I want to make sure I have the right file. I was doing a bull and a bear in the last class. That's why I'm just wondering if I put that in. Let me go back and check my ratios first. Yep, that's why. This is the bear. Undo. Damn it. This is 20.1. Hold on. Kill. File. Open as is. All right. Matching. Here we go. So when I put that in to the multiples, or the valuation, that for the Bloomberg enterprise value, I'm going to subtract out the 27,846, and then I'm going to subtract out the pension, which was 74.55. And what I end up with is, from a multiple that 1.54 against 1.58, 7.9812. It's not exact. I'm proxying these, but I'm getting much closer. So now I can do my bull and my bear. All right. And again, this was unanticipated, but this is what I mean by the real world. Like, this is the exceptions you're going to run into much more commonly than they used to. And sometimes it's not just about plugging and juggling. It's about understanding, like, what's causing the difference, and then trying to figure out a way to explain the difference. But I still want to go back, because I think this is actually instructive about CAT before we get to the cyclicality of the business. What is happening here with the valuation of the business, and how does this affect us? Because here's the other thing. In order to do the as is, if you solved for the G, what G did you get? Around 1%, give or take. That got you pretty close to the multiple. But the problem is, if we used a 1% G, we got a share price of 114, so we can't use a 1% G, even though that's what the multiples say. So what I ended up doing, conceptually, is use a 3% G, even though the multiple said to use a 1% G. What's the difference in that 2% of free cash flow? What's the difference here that we got to represent? I'm guessing I'm right, 90% confidence, not 100%, because I didn't dig too deeply into this either. But what do we really have to represent here? Let's go back to Migliani Miller. Operating value plus non-operating value equals enterprise value. I think the 1% growth in G is actually the operating value of Caterpillar manufacturing industrial equipment. What's the difference with the other 2%? The financing subsidiary. Because here's the other thing. We put the liabilities for the financing subsidiary, but we're not forecasting the profits from the finance subsidiary. And I'll go back to the way we set up the model. Because when we set up the model, remember we forecasted the income statement and all those one-time items and non-operating items we said don't worry about, right? Well, Caterpillar They got a big non-operating financing subsidiary that we actually do have to worry about. So if we put in the big liabilities, but we don't put any of the profits that those big liabilities are earning on the non-operating side, then we're going to miss the value of the company. So what I did, very simplistically, is the 1 to 3, the delta in that share price is the value of the non-operating subsidiary. Okay? Because at 1%, we got the value of CAT, making manufacturing products. At 3%, and that's what the multiple suggests, at 3%, then I'm going to add in this facility that has non-operating cash flows that are going to be netted against all those other adjustments because I got loans in those facilities that are going to be paid off. But the point is, that's the 2%. I don't think that that was the best way to do it. It was just a simplified shortcut to represent the difference between adding in the value. So what would have been a better way to handle the non-operating value than changing the G from 1 to 3%? This has been a great midterm 2 question, going by theory. What's the problem with me doing 1 to 3? I'm capturing the price, but what's the conceptual problem with what I just did? If I make the G 1 to 3, and I'll ask in the context of the valuation tab. What's the challenge of my 1 to 3? If I make 1 to 3, where does the cash flow go? Box 1, 2, 3, or 4. And if I change G, which box is changing? Operating or non-operating? Operating. So if I change G from 1 to 3, what I'm really saying is they're going to have more operating cash flow. But the financing subsidiary is not operating. So the real problem is I'm using more operating free cash flow to proxy the non-operating value. Now, technically, value is value, but what would have been a better way would have been to value the non-operating subsidiary's cash flow. Put that in here as a non-operating value. Add the 1% G operating value to the non-operating value of the financing subsidiary, then get an enterprise value, then get a share price. Because what I really would want to do is I'd want to value Caterpillar's manufacturing facility, and I want to value Caterpillar's manufacturing business, and then value Caterpillar's financing business separately, and then add them together, as opposed to lumping them together into a free cash flow value. Because it's really not driving free cash flow, because that's what our model's missing. Because our model is picking up free cash flow, but what's sitting there in the footnotes is they're making money below the line. They're not making operating value from this financing subsidiary, and our model's not picking it up. And so these are just adjustments that we tend to be on the lookout for when we deal with a company. So this actually made Caterpillar far more complex than I thought, but in a way, kind of these are bonus learnings that you get to when you deal with these real world questions. Yes, sir.
Is that a sign that they don't have confidence in the future of their business?
I don't think it's a sign they have confidence in the future of their business unless you're saying you think 1% is low. Is that what you're worried about, the 1%?
Like just with this, like this non-operating large amount of value.
Well, what it's saying is, and I'll say it a different way, which is starting with automobiles is something we can probably all relate to. The average dealer makes more money financing your car than they do selling your car. And so that's what's happening in a lot of industrial companies. And you can actually trace this back to GE in the 80s with Jack Welch. Is that what Jack Welch, historical CEO of GE, was very successful as he realized that they could make just as much money leasing the equipment as they could selling you the equipment. So they'd sell you a jet engine, lease the engine. They'd sell you a big power generating plant, lease the plant. They make money both ways, right? And so other industrial businesses started to say, look, we'll cut the banks out and we'll finance it ourselves and make money. I believe CAT to be one of those companies. They're saying, look, we think we can make more money on financing than just selling the asset itself, because these are very big, expensive things. And that's the other thing. It's how do you sell these things? I'm selling to people who need construction financing. It's easier to lease it than it is to buy it. So whatever the reason, that's one of the things. My other comment is the editorial. This is not easy to pick up on. And if you're not paying attention, it's easy to miss. Anything in the footnotes is easy to miss. This is why I go back to when I was railing about AOCI adjustments. This is what you guys are going to get paid to do. So for those of you that go work on accounting and accounting consulting, this is what they do. Because they're really good at figuring out what the rules are, figuring out how to use the loopholes in the rules to hide things from investors. And it's not saying that it's not there, but you gotta do a lot of digging. The average investor easily missed this. We had 160 finance people in this class. I don't think one of you picked up on this, right? And I'm just saying, we're people who should actually start to know this stuff. And I'm just saying, for investors, this is what they're good at. Give you one example. On Friday, there was an alarming article that I saw in the Wall Street Journal. This year, the accounting rules are changing in the US under GAAP, where you basically have to report all leases and put them on your balance sheet. You can't put operating leases off your balance sheet anymore. Okay? Again, just to be really clear, does everybody know what the difference is between operating lease and a capital lease?
Expense versus an asset.
Yeah, but specifically, what's the real difference between the two when it comes to balance sheet? Are you familiar with that?
If you're leasing it, it's not considered an asset, so your actual assets would be lower, and they can't look like you're making more money for your assets.
Yeah. Or let me say, put it on the financing side. So here's the point. If I'm an airline and I lease a plane, I only have, and I'll be more specific. I have a 3-year lease on my car. I'm 12 months into the lease. No matter what I do to the car, I owe 24 more payments to the bank. I can't get out of those payments on a lease. It's called an operating lease. Okay? If I were a business, how many of those payments show up as liabilities on my balance sheet? I got 24 more payments. I have to pay them no matter what I do with that car. How many payments do I put on my balance sheet today if I'm a business? 12. Anytime between 1 and 12. But generally you're supposed to do 1 year, but some companies will do a very short term. That's the whole point. So here's the point. At a minimum, I got a year worth of payments that are in a footnote somewhere that aren't on my balance sheet. Except I don't lease a plane for 1 year. I lease a plane for 10 years. So what's happening is you have all these industries that use lease financing, and same thing with lease assets, that have hidden debt on their balance sheet. And you have to dig through the footnotes to figure out what the leases are. And you have to manually capitalize them to figure it out. A lot of people miss that. So here was the article in the Wall Street Journal. They basically said, it's great that this year, all these companies are going to have their hidden debt put on the balance sheet for the first time, and they're going to have their credit ratings downgraded. And I'm thinking about this, and I was like, okay, so they have the same amount of debt. The only difference is one's hidden in the footnotes, one's on the actual balance sheet, and now you're going to downgrade them? And I'm just saying, this is how successful the accounting firms have gotten, is that the worst part of the article is they said they exempted the airline industry from lease capitalization. And they said the reason why is they said the airline industry would be the most distressed if they added all that debt to their balance sheet. So the credit rating agencies could give them better credit ratings by keeping it off their balance sheet. Think about that. If you're an investor, it's like, just ignore the debt that they actually can't get out of and lend them money at lower cost, and this is a good thing. This is what I mean by the craziness that exists in the real world. I'm going way off topic, but let me go back to CAP. They had $27 billion worth of liabilities. They're sitting in the footnotes, and Bloomberg put them out there. That's where they put their enterprise value. Our model missed that. Okay, so what we've had to do is we had to make the adjustment for the multiples. The second thing we had to adjust, ideally, is we should have made the adjustment as a non-operating cash flow, but for simplicity, I just changed my G. All that being said, bull and a bear. All right, give me a bull. What bull prices did you guys come up with? Give me an approximate price. Yeah. 190 or 140. So here's what I'm going to do. For very simplicity, I'm going to go to the ratios tab. And I'm going to get to 190. If I can see it. By changing the margin. And I'm guessing that's probably about 22% EBITDA. Nope, 20. Well, needs to be more than that. There we go. So I'm randomly changing some cash flows that get me there. But here's the real question. What were your assumptions about why you got to 190? Just generally.
I assume that they would be decreasing the number of fixed assets due to the current initiative they have.
Mm-hmm. So that you read about what they're trying to do with cutting costs.
Gonna be increasing their margins because of that.
Mhm.
And I checked the overall industry growth.
Yep.
And it seems like it's gonna grow a lot due to increase in spending, so increased revenue growth. Then I originally had calculated G as 1. I increased that to 3%. So you know that
Yep.
was a reasonable growth rate, which now seems like a reasonable growth rate. I did something.
Okay. So here's the point. When you do that, let's come over here and do our sanity check with the revised multiples. 190 is 2 times sales. Right now they're trading at 1.6 times sales. In this industry, is anybody 2 times sales? One company? Okay. That's a 10.6 times EBITDA. Is anybody paying 10.6 times EBITDA?
Yeah.
So what I'm saying is, you go through these ratios, 190 is probably harder to believe than maybe 180 or 170. And I'm not saying that the scenario itself isn't valid, right? Because this goes back to the question of cyclicality, right? So what you're really saying is that in the cycle that they're in, we're right now at a place where people are getting a little bit more pessimistic. And that basically, if the economy is a little bit better and they're tied to the economy, and if they end up selling more and they go into these new markets they're talking about and they grow faster, and if the competition in China is not as intense as it used to be, then basically what they can do is they can get more growth. And based on the cycle, we think that they'll get a higher growth over the cycle and a higher multiple over the cycle, right? So that's the problem, is that we do have to balance that out. That's why the G can't go up too much, with the fact that they have positive parts of the cycle, negative parts of the cycle. We're kind of trying to average the cycle out. So the other question is, where in the cycle, this is the point you were making earlier when you're trying to get the multiples to match, still the valid question. Where in the cycle are they? So that's the other question. Let me ask you by getting it in a different way. What was your bear price? So if this is the bull, and I'll just save the arbitrary bull because I overwritten my as is earlier. Cat bull. What kind of bear prices were you guys coming up with? 90? What are we getting? Okay. So again, 90, 120. What was your rationale on the 120?
I said that if there's a new administration that comes in, then likely the taxes will be at least 26% or higher. I also said that they could face some more regulations, which would increase their cost. And the other thing I said was based on their historical revenue growth, they're very volatile. So if they were to not have solid revenue again,
All right. So here's the point. Let's say that gets you to 120. It's not as bearish as the 81. So here's the point. At 120, with that negative rationale that was just explained, except for the tax rate, because 26% should have been your as-is tax rate, by the way. So that wouldn't be the bear tax rate. But back to the multiples. The 120 share price is a 1.28 multiple of earnings approximately, and it's about 6.5 times EBITDA and about 9 times EBIT. That's very much in the range of what this industry is trading at. So that suggests to me that that's a very reasonable, matter of fact, could even be more bearish than the bear, given the 80. Like, let's see if we can justify the 80 if things get a little bit more off the table. So the point is, if we get to 80, what's that going to take? I'm betting, I'm just going to make some random cash flow changes to make it easier, but that's probably closer to the 1% G, which gets me to a 90% price. So growing 90. It's tough to get to 80. 17. There we go. The number I'm changing don't matter as much because I'm just trying to get to a cash flow number as opposed to a reasonableness number. But here's the point I'm trying to say is 0.9, 0.464, 6 times, 8.6. I'm not saying it's not possible in this industry, but the whole point is it's a fundamentally different business. So I could see an argument for 80. I could see an argument for 120. Both bears could be reasonable. It's just a question of how bad do you think it could get, right? And there's just different degrees, right? So that's the point. Now it's a question of, what do I see? But you gave me an upside, you gave me a downside, and then where are CAT in the context of the cycle? So do you think CAT's valuation says that the market thinks that today there's more upside or more downside?
More downside.
Why?
Because the bear can go lower than using the sanity check, the bear is
Potentially the bear can inside that. I think there's another reason why it's lower to the downside. It's more of a bearish scenario at the current stock price than a bullish scenario for the industry as well. What else tips the hat on that one?
I would say the trade uncertainty right now doesn't help.
So you would have gotten to this in the EIC, but I'm saying what number in our model, when you did the as is, suggests that it's actually not going to be as good as it could be. The 1% G. If you actually solve for a 1% G, and we said that was pretty much the operating G of the business, then what you're probably saying is they're probably closer to the top of the cycle because there's less upside in that G than if you had a 3% G. Taking out the financing subsidiary kind of modification that I made. Because the whole point is we're saying that, think about the EIC. There's more of a probability of recession. There's more of a probability of companies and countries cutting back on some of their big capital infrastructure investments. Well, at that point, people are thinking there's more downside risk to the cycle of CAT. Therefore, given where they are over a cycle, they're at the higher end versus lower end. So it's probably more downside risk to the cycle than there is upside risk to the cycle. By the way, we play it through. If we were to do a multiples analysis, I'd be willing to bet, without data, I'd be willing to bet that you're seeing relatively low G's amongst some of their peers as well. Because what the market's saying is, look, it's probably more downside than upside. So we're going to be a little bit more pessimistic about how fast those cash flows are growing because we've got to average out the cycle. And there's probably more trough than peak left in the cycle. So therefore, whatever the reason is, if I were valuing CAT and going through what you just told me, I would probably put them closer to a hold than a buy. Okay? Because basically what I would say is, I think there's more downside risk in CAT than upside risk, even with the pricing in here. Because when you start looking at those multiples, we can go pretty far down and get to the middle of the industry, but it doesn't take much to get pretty far up and go beyond the industry, which probably suggests that the market is already kind of putting them at the higher end of the pricing today, assuming that the market's probably thinking this industry will get worse than better over time. And so again, to me, I'd have a harder time seeing, given the data out there about the intermediate term that we know with all the economic problems, the CAT is going to go against that grain. I think that they're actually going to struggle a little bit over the next few years. Hence, why they're cutting costs. Because they see this. We're not getting the revenue growth, so we got to take cost out because we're heading towards another part of the cycle. And in a way, I think CAT's kind of signaling to investors that they're going to be growth challenged in the next few years as well, despite the fact they say they want growth. You don't have to have that answer. That's just my suggestion. But this is just nuanced stuff that you have to get into. All right. End of homework 10. Questions about any of that? If you didn't get the G adjustment correct, or let me phrase, if you didn't get the multiples to match, but you still did the models, you'll still get the majority of the credit. Because this is a harder assignment than I thought. Because I thought we would just deal with the cyclicality of the business. We ended up having to deal with adjustments. But either way, I mean, like I said, to me, this is actually why I like this class, because you never know what you're going to walk into, right? And you got to always try and figure it out. And I would just say that's an important lesson in the real world because it's so easy to plug and chug, right? And you get almost reassurance because you do a Raytheon, you do a Costco, everything works well. And then you do a Caterpillar and you're like, what the hell? Like everything worked so well for the last company and then now this doesn't make any sense. You always got to reconcile that. So you just got to always be on the lookout. And that's also the advantage of the different approaches we're taking. Because, put it this way, if I just did an as-is DCF, we would have had zero of the conversation of the $27 billion adjustment. It wouldn't have even come up in today's class. And we would have misunderstood the asset we were valuing. So the other idea of doing the multiple approaches to come up with the same answer, it's just like you do the matching of the conversion of your statements. When you start to triangulate, helps you identify things. And by triangulating the multiples and the value of the DCF, we figured out that there was something going on with the off-balance sheet, the financing. And then we're able to make an adjustment. So anyways, let's talk about group case 3, because I know I've been postponing that discussion for about a week. So there is a solution to group case 3 on the website. It's under the Files section. Under GC3 is the tab. Where's it? Files. Group case 3. I do have a request. Please do not post this PDF anywhere outside this class. I'm being allowed to use this case as a favor from a friend of mine, David Wessels, who wrote the case. He's now at Warden, but he's an ex-McKinsey guy. They still use this case out in the real world at McKinsey. And so I'm kind of doing this with the don't put it on the internet. It's not just for academic reasons. It's just they don't want the analyst training program stuff out there in the real world. So this is just for your purposes for grading and seeing the solution. But that being said, so if we go through the solution and talk through group case 3. There we go. Preview app. There we go. You would have had to work through these 6 steps. So, step 1, industry at equilibrium. I'll keep it simple. Why is the industry at equilibrium? Why are the integrated players, despite losing $155 a ton, why aren't they selling off their equipment? You guys can check your answers against the numbers, but just why aren't they selling off? Why aren't they shutting down? What data on this page says it makes sense to continue operating?
ROIC and salvage value.
Yes. Why salvage value? What's the real difference between using the middle of the page and using the bottom of the page?
I would think to be the value if you leave the industry.
That's right. So in finance, it's basically the idea of a sunk cost. So we keep score on book value. And the book value says these assets are doing very poorly. Right? And so therefore, say in 3 ways, I don't want to reinvest at $2,000 a ton and make 2.25% at borrowing at 10. I don't want to, at 10%, need to make 200 a year and only make 45. I don't want to have a cash flow value to my firm in perpetuity that is less than, which would be 450, which is less than the 2,000 I would need to spend to build capacity. All 3 things tell you the same thing. I don't want to actually do new capacity. It would be a bad idea. And what I've done horribly. However, I can't change what I've spent historically. This is the score of what happened before. Right now, I got a plant that's worth $390. And so I have a plant that's worth $390. Do I make more cash if I stay or if I go? How much cash do you make if you stay? How much cash do you make if you go? Why would you want to go? You can be pissed off at me. You can say I'm a terrible manager. You can jump up and down about the horrible performance I've had. But regardless of all that, the fundamental fact is you're still better off letting me run the plant than shut it down. Because if you shut it down and you get $390 and you go take it someplace else, at 10%, you're going to make $39 a ton. And I'm going to give you $45 a ton. You're $6 better off doing the same thing. Or said a third way, 450 is greater than 390, 39 is less than 45. I'll make 11.5% in this plant based on its current market value. Your cost of capital is 10. You're better off staying. That's why the integrated players stay, despite the poor performance. Why didn't Nucor just expand the first generation plant? Why do they need to spend $2 billion in a second generation plant? Why not just run more of the first generation ones or build more first generation mini ones? Yeah.
Because I think it gets worse margin for producing multiple plants and they'll end up bringing the price down.
Well, and any capacity drives the price down.
Yeah.
Any price below 500 is going to send the profit and the ROI to a negative spread. So essentially, it's NPV negative. This is when you go in. This is when you go out. It's negative to go in. Any price lower than 500. Adding any capacity drives the price below 500. That's why the industry is at equilibrium. It doesn't make sense for people to leave. Doesn't make sense for people to come in. So the industry is going to stay about this point. What changes in step 2, which is an incremental step, is basically we dump 5 million tons in the market. It drops the price to 480 because we just saw the supply demand curve. Now, how does the logic change at a 480 price? What's different now for the integrated players versus what it was before?
Continuing cash flows.
Now I get 330 if I stay. I get 390 if I leave. Right? I get 8.5% if I stay on a 10% opportunity cost. Or said a third way, I give you at a 10% opportunity cost of an asset worth 390. I can make $39 elsewhere. I make 33 staying. All three of those things tell you it makes sense to shut down. So this is an iterative step. It's not necessary to actually solve the case, but it's very instructive because it does say that at a certain price point, it actually does make sense to shut down. And we cross that threshold somewhere. So we started the case, ugly but stay. Then we go to this next place, ugly and leave. And so you wonder how industries can actually operate for years, not earning their cost of capital, and why they don't shut down. This is the answer. Because shutting down is actually worse than keep going. And so that's the point. That's what we have to understand. So I know you can't see this on the video, but I drew on the whiteboard here, got a whack. Whack over time. Above your whack over time and below your whack over time on a line chart. When do you invest? When do you pay out? This is a midterm 2 question. When do you invest? When do you pay out? Relative to your whack. So if you're above your whack, do you invest or pay out with the returns of your investment? And you're below your whack, you pay out, right? Okay, so here's the difference. If you think it through, so if I'm below my whack, I don't want to invest. And generally, I also, that's the middle of the page. And then the bottom of the page says if I'm below my whack, I want to shut down. But here's the point. I'm in what I call the zone of pain. I'm still generating enough cash flow to pay my bills. I'm just not making enough to give the shareholders the 10% they expect. I call this the zone of pain. We can continue operating in the zone of pain for a long time. And that was step 1. We're just in the zone of pain. The industry sucks, but there's no alternative use for our assets, so we're going to keep doing this. That's called the auto industry today. Those negative spread industries are in that situation right now because the auto industry has too much capacity, too much investment relative to the price of the cars, and they're just not making money. But they can survive. Because what's the key number long term where you can't survive? You can survive. Your shareholders get pissed at you, but you can survive earning less than the whack. But you can't earn less than the what? When does the zone of pain become the zone of death?
What's in the salvage?
Nope, not the salvage, but even more importantly, yeah, cost of debt. When you can't cover the cost of debt long term, then you're done. And here's what I mean by that. Because you can avoid paying a shareholder a dividend. They can get pissed off at you, they can threaten to relieve you, but it doesn't shut down the business. If you miss a debt payment and you default, you're done. So what I'm telling you is if you can't cover those debt payments long term, that's when you can't survive as a company. So it's not the whack that is dangerous. I'm not saying shareholders are upset by this, but it's the cost of debt. That's when you really have to throw in the towel. So that's when you go to the zone of death. That's when you actually have to shut down. So that's the key point here. And so what's happening in step 1 is we get to the point where, all right, now it makes sense rationally to stay. We can justify it. But in stage 2, it doesn't. Now it makes more sense to leave on a salvage value basis. So step 3, when do they stop leaving? When this becomes 0. And when you work backwards, that's a 490 price. And a 490 price, second generation mill makes 54 a ton, which is a 12% ROI in the new investment. So likely, that's positive spread, positive IRR. So we're probably going to want to invest, but that's the point. That's only for 5 years. Year 6, everybody has access to our capacity. When everybody has access to our capacity, they're going to keep entering until the cost of capital equals the ROIC. When this spread of economic profit is 0, that's when they're going to stop investing, which is a 475 price point. So the whole point of this case is to say, when you have new capacity going to industry, pricing is dynamic. And if we use current price today, we'll overvalue this project. Because what's going to happen, step 4, is we're going to make $270 million in cash flow a year when we have competitive advantage. And we're going to make $225 million in cash flow per year when the price falls to $475 and we lost our competitive advantage. When we value the whole project, we're at a 171 NPV approximately, because it's 171, 172 based on rounding. And so therefore, assuming you believe these assumptions, you want to do this project. But this is what's instructive about economic value added, or EVA, also known as economic profit, at the bottom of the page. NPV tells you how much cash value you generate. But the one thing NPV doesn't tell you is when you generate that cash value. Step 3, we make $9 million of economic profit per ton for each year for the first 5 years, which is $45 million to value a year. Step 2, we make 0 economic profit year 6 forward when the price falls to 75. When is all the value of the company created? What's unique about the first 5 years? They what? Correct. That's during the period of competitive advantage. So this is the other important insight, which is why I wanted you the case. This is why the C in EIC is critical, because it's all about competitive advantage. When you have competitive advantage, you can generate a positive spread, and that's the value that you're really creating for the investors. When you lack a competitive advantage and you do equal to everybody else, you're in your cost of capital or below your cost of capital, there's no value to that. Think about pharmaceutical companies. Pharmaceutical companies make all their money when drugs are under patent. The second that patent expires, price plummets. They still generate cash flow, but they're like Nucor in stage 4. They're NPV 0 cash flows. So the real value is the time under patent protection. And so that's what I'm saying, is that what's very important here to understand is when we forecast a company, the real value, and this is the third part of the key value drivers, how long are they going to maintain their competitive advantage? Because the shorter that period of time, the less value they're going to create. The longer the period of time, the more value they're going to create. So they want to optimize during that period of time. And that's why extending that advantage or finding new advantages starts to become really important. And that's one of the other things that this case illustrates. Okay. By the way, there'd be some cannibalization. We're the only game in town for the first 5 years, so we are losing sales in our first generation plant. We have to knock off the $6 million of cash flow, $3 million after tax, and basically we lose $11 million by cannibalizing ourselves for the first 5 years. Year 6, it's not incremental anymore, so we don't worry about it. So overall project NPV about 159. Questions about that? All right, I want to show you one other element of the case. So I'm going to go back to Excel. File, new. All right. So let's look at step 3, and let's consider, I'll just do old Nucor and new Nucor, new plant. What's the margin in step 3 that they earn on this case? Right to step 3. 54 divided by 490 is the margin, and the old plan is 54 divided by 490. You did the math right. So equals 54 divided by 490. And the point is, they both make an 11% profit margin selling steel, whether it's the old or new plant. But the difference is the productivity. How much investment is required to do $1 of sales. So investment is to build the first generation mill, 600, and for the second generation mill, 450. So here, where our productivity is 600 divided by the price, sales, this is where I'll do this per ton basis, the price dropped to 490. And here the productivity is 450 divided by 490. Gets me an ROIC. I'm going to be a little smaller so you can see what's going on here. Equals the 54 divided by the 600, 54 divided by the 450 are the two ROICs. And the WACC So what's the real difference between first and second generation new corn? What's the primary difference between the first and second generation plants with this data? Which one do you want to invest in? Yeah?
The new ones being more productive.
And generating a positive spread. And then old one is less productive as a negative spread. But why, saying your same words, what's the real difference between the two? Not just the spread, what's driving the spread? Key value driver, it's productivity. This is a case about productivity. And what I want you to understand is the impact of productivity on free cash flow. And this goes back to why ROIC is a proxy for free cash flow. If, and this goes back to competitive advantage, if I am more efficient than you, if I can use less capital to drive sales without compromising safety or quality, I'm going to win. That's real competitive advantage. That was industry changing. That's why a few weeks ago when I drove to Bethlehem, PA, in a session at Lehigh, it was very tragic to watch the old plant downtown Bethlehem. Giant steel mill, rusted, falling apart, shuttered down. And it's just technology moved on. And that's the problem. If your competitor has the next generation technology, this happens in tech all the time, or if they have the next process, or they have that productivity advantage, over time, you're going to have real trouble. And that becomes a source of competitive advantage. If you go back to the 80s, the real reason why the US auto industry lost to the Japanese was 3 versus 5. What were those two numbers? What did that represent in the 80s? 3 versus 5. What would you guess? I know some of you probably weren't even born, but what would you guess for an automobile? Toyota versus General Motors. 3 versus 5. Yeah. Close. It was how long to do the next generation car. Toyota was churning, and Honda were churning out cars, next generation cars, new models, real models. That's what incremental change. It's about every 3 years. And General Motors, Chrysler, Ford took about 5 years. They were slow. So just think about this. Over 10 years, Detroit's got 2 models. Japan had 3. And over time, what was just happening is they were just innovating at a faster rate than the US. And eventually, people stopped wanting to buy US cars, and we wanted to start buying Japanese cars and eventually German cars. And so it wasn't about margin. They were selling these cars cheaper. But if you go back and you look, they were using less investment to drive sales because it was all about efficiency of process. And so whether it's Nucor steel, whether it's technology or anything else, productivity is very important in ROIC and free cash flow. And that's what this illustrates in the case. It was a game changer in the steel industry. If you had the productivity advantage that your peers don't, you're going to lose. It's happening in the chip business today to Intel, right? ARM, if you've been paying attention, is winning the race for chips because ARM is now making chips. I think that iPhone chip is like 7, what's it called, nanometers or something, and Intel is struggling to get on the 10 process, and so their competitors are 2 fab generations ahead of Intel, and Intel is now behind and actually getting their new chips at scale to the marketplace, and it's actually starting to cause disruption, and it's causing disruption in other ways because people like Qualcomm, people like ARM, Apple to some degree, are innovating at a faster rate. And that's why you're starting to see companies like Apple saying, look, in the next generation of Macs, we don't need Intel chips because our chips are actually faster because we are more efficient. Intel was the opposite 10 years ago, which is why AMD couldn't keep up with it. So when I go back to productivity is competitive advantage. So invested capital to sales is something that's not an afterthought. If it's similar across firms, it doesn't matter as much. But if it's different and your competitor, without compromising quality or safety, is faster than you, it could be game changing, and that's what happened in this business. So 3 important lessons learned. Number 1, when you do a DCF, static pricing and static cash flows is dangerous because you'll often overshoot. Number 2, that when you do try to figure this stuff out, ROI-based pricing, working backwards to think through price, is actually more accurate than directly forecasting price over time. So that's actually one of the reasons why we do an EIC. Because the whole point is, if the industry makes 10% and nothing changes about the industry, it's going to make 10% in the future, which means if your costs go down, your price goes down. And the common mistake an analyst will make is that the industry makes 10% and the ROIC shouldn't change. The cost goes down, they'll assume price stays the same, and they'll essentially project a higher ROIC. And what I'm telling you is that's not realistic when you actually look at the data. Because if the ROIC stays at 10% and the forces don't change, then the competition will erode that excess advantage and keep you at 10%. So I go back to, and indirectly, what this case suggests is that over time, you earn your ROIC, and so therefore we can actually back into pricing based on ROIC, which was one of the lessons of the case. And then finally, the competitive advantage key is critical. All your value, all your real DCF value is during that time to make competitive advantage. So understanding a competitive advantage for a company and how long it lasts is actually critical to the valuation. So those were 3 of the insights I wanted to talk about, and that productivity is a source of competitive advantage. So that was group case 3. So as you're doing your group projects, you want to understand that this is also why the EIC and the model eventually have to sync. Because the EIC, in a way, is helping you forecast ROIC. Right? And if you say the ROIC is not changing, and you start seeing our margins improve, you're going to start questioning that assumption. Because that margin improvement in your valuation increases the ROIC, and the EIC says the ROIC is not going to increase, then unless you have more competitive advantage, you're probably being too optimistic. So that's the other insight to tie into your questions. There is not a homework assignment between now and Wednesday. Wednesday, we'll start and work on class on the final homework assignment, in-class homework assignment for the semester. If you finish in class, you're done. If not, it'll be due on Monday. Okay, see everybody on Wednesday.